Hello and welcome to Fireside Chats on Nomura Podcasts. I'm your host, Jordan Rochester from the Global Markets Research Team. And in this episode of our Fireside, we'll be talking with both Sook Leen and Jarek. Sook Leen is our head of capital advisory and Jarek is our head of sustainable finance at Nomura. And I'll be asking them both about their latest thoughts on ESG. It's a big topic and we'll have a few of these in a series. But in this podcast, we're going to be talking about the state of the ESG issuance pipeline and the next big trend for next year. But we're going to zoom in on a specific topic, which is an interesting part of how ESG is being used and how it's being used within bank capital issuance. We're going to ask the question whether you can use a bond as both capital and as a green financing tool. And I'm going to throw in a few questions on the challenges that ESG faces in the years ahead. Now, I've got to admit, I'm quite excited about this podcast. ESG is a big theme. It's one of the biggest financial innovations I've seen in our careers post the global financial crash. There's been many conferences and seminars on ESG within the finance industry. So I've got Sook Leen and Jarek, who are the experts on these topics in particular at Nomura. And I want to go over the broader ESG market briefly with you and then pick your brains on this bank capital topic that we're going to zoom in on. Now, we've all known each other for quite some time, but for folks listening, Sook Leen and Jarek, can you both just introduce yourselves and give us a bit of color on what your focus is on the ESG space?
Sure. Hi, Jordan, and hi to the audience. It's a pleasure to be here. My name is Jarek Olszowka. I'm the head of Nomura's sustainable finance business outside of Japan and member of Nomura's debt syndicate. And by way of background, my team focuses on origination, structuring, executing transactions which are ESG driven. Bulk of our focus have been debt instruments in ESG format. We'll dive into this later, but at this stage, I just wanted to highlight that Nomura has been committed to this market since early days. We've been lead arranging since all the way back since 2012. And to give the audience an idea, this year alone, we have lead arranged to more than $60 billion in terms of notional of green, social, and sustainability. So very significant volume. And it's a pleasure to share the fireside chat with Sook Leen. I used to work in Sook Leen's team prior to moving into sustainable finance, and can certainly vouch that she is one of the preeminent experts on all things related to bank capital. So a real pleasure.
Thanks for that, Jarek. So as mentioned already, I run the capital advisory team and we sit within the debt capital markets division, and that is within the overall investment banking business of Nomura. And the focus of my team is to look at the capital requirements that banks need to meet. And clearly that has been a big focus, especially since the global financial crisis, where it's been very important to ensure that banks have enough capital to operate and continue to serve as the lifeblood of the economy. The other area of our focus as well is looking at liability management transactions, looking at optimizing the capital structure for banks. And, one of the key successes for this year that we were proud of, and I think is very topical for today, is a transaction we did for the Volksbank. It was the first green tier 2 issued by a European bank. And it was an extremely successful transaction. So maybe I'll pause there and we can take it back to you, Jordan.
Well, all of those successful transactions is why we're talking about ESG as a whole. I mean, the green bond issuance and more broadly, social governance, ESG bonds have been one of the big focuses of 2020. I know it's been a COVID-19 dominated year, but it's also been a record year for issuance. Particular, we've had social issuance really picking up with the pandemic and the EU's Sure Start program, the social issuance there, and also more broadly from firms and sovereigns too. It's important that no matter what our role in finance, that we take note of these news trends. As more and more workplaces are adopting ESG initiatives, and the size of issuance has gotten to a level that is now truly becoming hard to ignore. Eventually, instead of plotting core Govy rate spreads, I wonder whether for myself, my day-to-day FX job, in a few years' time, I'll be plotting the performance of relative ESG bonds to figure out the next trend for FX. Who knows? And that's because ESG issuance is now, we've gone past the $1 trillion mark this September, and it continues to rise each quarter. Now, whenever I say $1 trillion, we have to always put it into perspective. I imagine Dr. Evil from Austin Powers holding his cat whilst he says it, $1 trillion. But this is the complete opposite of evil. We're talking about issuance designed to fund the overall social good. And it's also a large number. It's about a third of Germany's GDP roundabouts in terms of issuance so far. But that's on a global basis. So look, we're going to do a lot more than just talk about how great ESG and the issuance pipeline is. I want to get into the weeds of what this means for you guys on a day-to-day basis. But Jarek, before we do that, I just want to ask you about the sort of highlights you've seen. We've all been getting used to COVID-19 this year, but for you, it's been dealing with also record numbers of ESG. So what sort of the highlights have you seen?
Yeah, so maybe before I outline a few trends in 2020, for us at Nomura, we've been acting on many transactions which were very innovative, first of their kind. Like we were the underwriter for the EU's first ever ESG bond, so that was a 17 billion euro jumbo print in the form of sure social bonds, with the proceeds being used on lend to member states to counter rising unemployment relating to COVID, so various short-term schemes. We for example, lead arranged first ever green sovereign bond in samurai format. That was for the Republic of Hungary, or the first ever tier 2 in Europe, the one that Sook Leen has mentioned, and which we will talk later for the Volksbank. And other than that, we've been in 2019-20 a member of ICMA Green Bond Principles and Social Bond Principles Advisory Council, one of the 5 banks only globally, and in this role on the council. This is the main industry body which drives the entire ESG bond market. So we've been helping to further the market, to work on new products, and we've also picked up a number of awards in this space. I won't bore the audience. I'll just mention the recent Investment Bank of the Year for Sustainable Corporate Finance Award, and runner-up for most impressive investment bank in Asia Pacific, Green SRI Capital Markets from Global Capital and the Banker, respectively. So, but going back to your question on 2020, we to me, clearly this was the year of continuous rise of ESG investing. The COVID-19 pandemic has accelerated clearly the focus on sustainability. And in our view, if there were any residual doubts whether sustainable finance is here to stay, that's all now gone. As you mentioned, green bonds passed the US $1 trillion equivalent milestones in terms of cumulative issuance. And although we have seen, as I would say, a temporary dip in issuance when the first lockdowns in Europe in March and April started, green bond issuance has rebounded super strongly. It surpassed all previous issuance records. But to me, this was really the year where ESG moved from green to what I would say more of a rainbow approach. So a lot of focus on social, wider sustainability aspects. During the pandemic, social bonds have seen unprecedented growth in issuance, so growing year on year more than 700%. And I think the last months also showed that this use of proceeds-based concept, which has so far been applied mainly to tackle climate change, climate mitigation, can be easily applied to other parts of the economy. So tackle health emergency, support employment, provide liquidity to SMEs, funding for R&D for medicines, including vaccinations. And a lot of the issuance has been coming from sovereigns, supranationals, agencies, but banks accounted for a big chunk of issuance. So around 20% of all green bonds in the past year, they have been issued by financial institutions, which brings us back to our today's topic.
Well, yeah, a quick question. Is ESG issuance still a big Europe story? We've got a new administration on the way in the US. So you were just talking about the issuance pipeline next year. Is there potential for the US to play a larger role, do you think, in 2021?
Yeah, it's certainly Europe is still at the forefront if you look at both issuance volumes and diversification, and also if you look at the regulatory backdrop. That's one of the key distinguishing factors, that the European Union is doing a lot of work on this front, with the EU Green Deal coming in, with the Next Generation EU Pandemic Fund, with potentially up to 230 billion of the 750 billion recovery fund earmarked towards green bonds, regulation on taxonomy. So I'm sure we're going to have a separate podcast on this, but this is a huge piece of legislation which will actually define what it means for an activity to be sustainable. US indeed has been lagging, and there is big hope with the incoming administration. We've seen already appointments with a dossier given for climate change to very senior representatives, and hopefully some of the legislative proposals which in the last month the Department of Justice was debating, for example, preventing pension funds to take ESG factors into consideration. So going totally against the trend which we're seeing elsewhere around the world, that this will be halted. And there's still certainly there's a lot of development on the asset management side. So with a supportive governmental regulatory backdrop, I think this could be a year where ESG is going to really accelerate in US, and we've seen in the past few months, for example, a number of US banks issuing in particular social bonds relating to kind of racial equality, to kind of focusing more on the societal aspects, and so I think that this will continue, certainly.
Absolutely. I mean, the space is already mature enough that before this podcast, I was looking on Bloomberg, and you can create and filter, and you can make your models to find out and iron out the different bonds that you want based on certain characteristics of the issuance itself. The percentage of females on the board, the gender pay gap, all of that can be filtered for. The information is there. It's going to be a proper market. Right. So, Leen, after all of that from Jarek, what's been the main lessons for you this year in the ESG space, and what sort of growth and takeaways do you have?
Sure. So I think what's interesting, as mentioned previously, is that this is the first year we've really seen a lot more bank capital in ESG formats. We've actually seen what we call MREL and TLAC instruments issued in green or social formats before, and we'll go into a bit of more detail what we mean by those instruments. We love acronyms in the bank capital space, but we'll go into that in a bit more detail shortly. But this is the first year we've seen actually a lot more tier 2 and tier 1 instruments in ESG formats. And I think there are a variety of reasons why that's the case. I think because these instruments are issued to meet certain regulatory requirements, banks in the past have tended to be a bit more cautious. They want to make sure that the instrument really does tick the box and meets its intended purpose primarily, which is to count as regulatory capital. But I think there's been a lot more familiarity and awareness of the ESG formats, as Jarek mentioned, it's a space that's just growing, and it will only go in one direction, which is becoming a bigger and bigger part of bond issuance. I think there's been a lot more understanding as well, and so there is a sense that there is no issue at all with issuing a regulatory capital instrument with an ESG label. The two are completely consistent, and it works. I'd say the other thing that comes to mind, and if we think about the pandemic and COVID as well, is that banks actually have less to do in terms of general funding. So central bank TLTRO, TFS in the UK has meant that a lot of the regular senior preferred or covered bond funding that a bank does to finance its activities, those volumes have fallen, but the need to raise debts in the form of capital is still there. And so with the sort of awareness of the product, more and more green bond frameworks or social bond frameworks being set up by banks, and also there being more of a need in terms of capital, I think that's why all of those have come together to, for us to see, the first sort of, I would say a wave. I would say a huge wave, but it's sort of definitely a growing wave of issuers starting to go, look, I can consider issuing bank capital in ESG formats.
Well, let's talk about that more in depth then. Let's get into the weeds of bank capital. You mentioned there's lots of acronyms, so I hope I can keep up with you, but let's get the lingo out of the way and understand what we mean by this bank capital and how ESG fits into that.
Sure. So I'll try to make it as sort of simple and streamlined We love detail where we are, and Jarek knows as well, having been in our team. That's why it's sort of perfectly suited to the ESG hat that he sort of is pioneering right now. So just to clarify, we're referring to, I'm going to use a lot of these acronyms as well, so it's just good to clarify that from the start. So when we talk about bank capital, we mean primarily instruments that a bank can issue to meet its regulatory capital instrument requirements. And, they are actually debt instruments, but they count towards capital. So there are two main types. One is called the additional tier 1, or AT1 in short. And there are also what we call tier 2 instruments. And they have differing levels of equity-like features that the regulator goes, even though it's a debt instrument, it has enough features that mimic equity that I would allow you to count it as capital for a bank. And this is regulatory capital requirements that a bank needs to have for it to operate on a day-to-day basis, on a going concern basis, if you like. We also talked about MREL and TLAC, and that's also a huge topic at the moment. And if you like, you can think of it as a second line of defense. So TLAC stands for total loss absorbing capacity, and MREL is the European equivalent of that. It stands for minimum requirements of own funds and eligible liabilities. And the intention here is that actually, if a bank sort of goes through a period of crisis and depletes its going concern capital, MREL and TLAC is meant to ensure that the bank has sufficient firepower and debt that can be credibly, feasibly bailed in, which means that governments don't have to bail out banks any longer. So right now, a lot of the banks, in addition to filling up their AT1 and Tier 2 capital requirements, are required to meet MREL and TLAC requirements as well. So MREL and TLAC are certain types of senior bonds which are structured in a way that allow them to tick that box as well. So as mentioned, we actually have seen a lot more MREL and TLAC issuance in ESG format. We've seen that since 2018. At Nomura, we've worked on a few green senior non-preferred, for instance, for the likes of Santander and Deutsche Bank. But I think our focus today is probably going to be more bank capital in the sense of AT1 and Tier 2 instruments, because that's what's new this year.
Well, I'm coming from this with an FX hat on. I'm not going to make it FX, but from what you described to me there, Sook Leen, it sounds like it could become a self-reinforcing cycle. So banks make ESG issuance a part of their bank capital, increasing the demand further for ESG issuance, but it also increases the requirements for firms to uphold those ESG standards. Jarek, what's your thoughts here about this sort of bank capital story that's playing out?
I would say I would just highlight that the ESG no longer a niche like it used to be a few years ago. That's clearly all industries have a role to play in tackling sustainability, including, or I would say even especially financial industry, taking into consideration the importance that as intermediaries, banks play a role where capital is allocated to which industries. And from the buy side perspective, they're placing an ever increasing importance on ESG credentials, and issuing a bond in ESG format is a means by which the issuer banks can signal to the market their strength and show they are channeling capital towards specific projects. So Sook Leen mentioned, for example, Santander or Deutsche Bank, where the proceeds we've lead arranged and were dedicated towards renewable energy. But we've also done, for example, a social bond also in senior format for RBS, which was the first social bond from a UK financial institution. And there the use of proceeds was dedicated towards providing loans to SMEs in the most impoverished parts of the UK. So going postcode by postcode, looking at Office of National Statistics at various number of claims made. So directing money for social purposes. For example, we've done also for BBVA a social bond, which was the first COVID-19 response bond from a European bank, and again providing liquidity and also channeling funds for healthcare. So I just want to highlight there's a kind of wide spectrum of projects that can be targeted with these bonds. It's not purely climate related. But to me, the benefits, apart from issuing in bank capital, where you're satisfying capital requirements, but also pursuing an ESG agenda, the benefits we observe in syndicate when we price such a bond. We certainly see higher oversubscription levels at issuance. It helps a lot to diversify funding. We see an incremental specialized investor base, so you get all your normal buyers for a given name, plus you get all these dedicated players, or you get higher orders put in, because a lot of the more mainstream funds, they have either internal soft targets or they have specific ESG mandates from asset owners, even if they're not running a dedicated pool. So that obviously results in I would say, favorable technical backdrop from issuers' perspective. So we've seen some potential price saving and possibility of obtaining a greenium. So this is where the bond prices through the issuer's existing secondary curve. And we've seen this occur in some instances. It cannot be guaranteed, and it depends on type of instrument, credit quality of issuer, and there are counter arguments to this raised by the buy side, some good ones, that these bonds don't have any additional events of default undertaking, so they have full recourse to the whole balance sheet of the issuer, so it's the same credit. So their argument is that this should price tighter, but it has to be said that we do observe in the market some price differential. And finally, I would like to highlight that there's potential for secondary performance of ESG bonds. I think it's very important versus conventional. A lot of the buyers of the ESG products are very buy to hold in nature, and so we have seen these bonds perform better in times of stress. So, for example, a good litmus test was the March COVID-19 related sell-off, where portfolio managers tended to hold on to ESG bonds due to their scarcity value. So they wouldn't offload them, at least not unless they really had to. So
absolutely. I've been looking at the ETF inflows. October wasn't a great month for equities either. It wasn't as bad as March. But most of the ETF inflows we saw in Europe were actually into ESG related ETFs. So it shows you how in good times and bad times, these inflows seem to be more consistent, which is the point you made there. I want to bring this back to what Sook Leen was talking about, which is using this sort of issuance for bank capital. My simple head on, I thought when you have green issuance, it's going to go towards a new green project, infrastructure spending and so forth. But a bank capital instrument is also intended to be loss absorbing in a crisis. So Sook Leen, can we really combine an instrument that is loss absorbing in a crisis, but one that is also supposed to support green social project financing?
Sure. So I'll probably answer this in two parts. I think first, it's just important to highlight that because it's issued to meet regulatory capital requirements, it's important that regulators are comfortable that you have an instrument which is bank capital, but the fact that it has an ESG label doesn't jeopardize the loss absorbing nature of the instrument. And I guess the key criteria here is one of permanence. So regulators want to make sure that if an instrument is meant to be part of regulatory capital, that it's going to remain in situ in the capital stack. So, for instance, AT1 instruments have to be perpetual. Tier 2 instruments have a minimum maturity of 5 years, but typical structures are 10-year instruments, including those with a call option at the issuer's discretion after 5 years. So one of the key questions that arises is, what would happen if you issue an ESG tier 2 instrument, for instance, and your use of proceeds is to green or social projects, but what would happen if those assets are no longer there? Will this create an incentive for the issuer to redeem the instruments early? And clearly that's something that regulators don't like and is not allowed according to the rules. So that's sort of, I guess, from a regulatory perspective, to ensure it continues to operate as it should. This is one of the key questions. And I think it's important to understand the construct of an ESG bond. There are no events of default if the use of proceeds are not for any reason, if the issuer is unable to allocate those use of proceeds as stated, it doesn't create any early repayment rights. It doesn't trigger any acceleration rights, and that's important for the regulator, I think, to be comfortable with the bank capital instruments being an ESG financing tool at the same time. And then perhaps maybe going more towards your sort of philosophical question, Jordan, around, if something is loss absorbing or meant to be loss absorbing in the crisis, but at the same time it's meant to finance green projects or social projects, well, isn't there a conflict? Because you have an instrument which, at a point of crisis, if the issuer runs into difficulty, is meant to absorb losses, but is intended to finance green projects. So how would it work if the issuer goes into difficulty because of brown assets that it has, for instance? So Jarek, maybe you'd like to comment on how the ESG bond, again, how it's structured, how we would be able to understand the way we could marry the two.
Yeah, sure. I think it's worth keeping in mind that looking at the green or social bond principles, it's all focused on the use of proceeds. So on the types of assets that are being financed and refinanced, and so it doesn't go into the, I would say, liability side of the balance sheet of the issuer. And so to me, I don't see a contradiction. I think it would be very problematic if we would have, for example, a green or non-green point of non-viability or bail-in triggers. And I don't think we'll ever see CRD5 or CRR2 kind of progressing towards that, because I think that would create a very different asset class. So to me, as long as the proceeds are used as stipulated, I feel quite comfortable with it.
Yeah, I think the other question that comes to my mind is that it's there is no ring fencing of assets, are there? So it's a question of how the cash that's being raised from this debt financing, what do you apply those cash proceeds to, rather than actually having a segregated or ring fence set of assets. So there is no linkage in terms of actually how this bond is meant to perform versus the assets. It's more about where you invest those cash proceeds, or an amount equivalent to those cash proceeds. And wouldn't you say that it's a problem that exists for any green bond, right? Any issuer, it could be a corporate bond issuer who does an ESG bond, and the credit risk of the instruments is unchanged, right? Whether or not it has an ESG label or not.
Yeah, I fully agree. Unless it's a pure play issuer with 100% green balance sheet, then regardless of the level of subordination, there will be, to either lesser or more extent, but it will be supporting non-green assets at the end of the day, even if it's a senior preferred bond. So I think there's no escaping from that, and I think ICMA's and the kind of the market's focus is on ensuring that proceeds are earmarked against certain projects, and that's how we want to scale up the market and grow the market. And I don't think just because an instrument is more deeply subordinated, then it plays less of a role. And I know there have been some voices which wanted to factor in the kind of leverage effect and of a capital instrument, saying that they want to see more projects being potentially funded or earmarked against in case of an 81 Tier 2 versus a senior preferred covered. But so far we haven't seen such a construct emerge, and I think it would be pretty hard in practice to expect that with the current regulatory backdrop.
Well, guys, but there's definitely still a tension here. Like I have read around the topic, and there is the articles. There's folks saying that issuance in green bank capital is akin to greenwashing. And just a short, quick answer: is that fair?
Short answer: I don't think it's fair at all, Jordan. To be honest, I think the key difference between ESG bonds, regardless of level of subordination and conventional, is the added reporting and disclosures obligations which issuers commit when issuing green social bonds. And with bank bonds, we have acted on and we have seen in ESG format that the issuers have been very clear what the proceeds are intended to be used for, in what amounts. They very often go into detail saying what is being used, the kind of percentage split of financing, refinancing. In case of refinancing, what is the maximum look back period? So how long has the capex already been financed? And issuers obtain external verification from second party opinion providers. And additionally, with this kind of annual allocation and impact reporting, often that's externally audited as well. So and finally, I would say ESG investors spend a lot of time and effort to police, and I think there would be significant market backlash if there was greenwashing. There would be either divestment. I'm pretty sure you would see it featured prominently in the top of or in the front pages of the FT, and I also think regulatory standards they are tightening. There's an incoming EU taxonomy, the potentially coming in 2021 EU Green Bond Standard, which all further kind of focus on stamping out any attempts of bad behavior. But I would just highlight that the market has been disciplined. And I don't know, Sook Leen, if you want to add anything more kind of specifically on the capital angle, whether that's greenwashing, because...
Sure. I mean, I'll just add, and just taking on very quickly from what you've said, Jarek, around leverage, the leverage impact. I think there are some in the investor community who sort of again fundamentally ask the question of what's a green capital instrument, and bearing in mind that capital is issued to support a larger volume of assets than just on a one-for-one basis. So, as you mentioned, there's a question of, is it enough from an impact perspective to just invest one-for-one of a 500 million bond into 500 million of green assets? How should we look at impacts more holistically? And I think it is part of a general trend for many investors to sort of go, yes, we value and we do see the benefits of having green bonds, but also they want to see broader commitment levels. And actually the issuer itself moving more towards a green target in general. And I think that's right and fair. And I think that's probably the direction of travel. I think what I'll say is that having a green capital instrument actually means that it provides the issuer with a springboard almost to be able to grow its green assets. And I think it is important for the issuer, as you mentioned, to commit to long-term sustainability and green goals, and for it to be all part of the story, to be all part of the disclosure and the rigorous monitoring of these instruments.
My takeaway from all of this, guys, is that essentially we've got a self-fulfilling cycle. The more ESG issuance is used, the more, Jarek, you spoke about how this greenwashing can't be allowed. The market's going to be enforcing the social governance to be followed. And I guess there's going to be folks whose job will be, including yourself, Jarek, to track how firms and sovereigns are adhering to the green standards. Look, we've just got a couple of minutes left. In fact, just 2 or 3 minutes left. I'd like to get a quick closing comment from both of you. What's your prediction next year on both the supply of bank debt in ESG format for next year?
Sure. So I think in terms of bank issuance, we certainly expect increased volumes of ESG bonds hitting the market versus 2020. 2020, there was a bit of a slowdown, and I think, but it was more a function of the lower overall fixed supply. And in terms of the various layers of bank debt, covered bond supply will continue to grow. This trend has materialized already. So despite conventional covered bonds have been globally down by a good 50 billion euros, this was the year with the highest amount of covered bonds in ESG format. One caveat here is that this will require the European Commission not to end up introducing in their taxonomy too restrictive criteria for what is defined as a green building. This is currently a hotly debated topic, and there's a consultation out. In terms of other layers, and senior preferred and non-preferred, I think with issuers filling MREL requirements, they will continue to do so while trying to meet ESG targets. Tier 2 issuance in green or perhaps even in social format, I anticipate we're going to see much more of that. AT1, I think, remains more problematic due to the perpetual nature potentially of the instrument and the concerns voiced from part of the bank capital investor base that Sook Leen outlined so well. But I don't know what you think, Sook Leen, and whether you agree with this or.
Yeah, no, I absolutely echo that. From what we're hearing from issuers, I think there is a lot more of a, seeing as well, the issuance this year. I think that there is going to be only more familiarity and comfort in issuing in bank capital format. I agree with you. I think tier 2 is probably where most issuers will focus on. But yeah, as you say, with an AT1 instrument, it being perpetual, you just have to make sure that you have on the asset side sort of sufficient assets, a good churn to be able to sort of match the two. But yeah, I think again, just like the overall ESG market is only going one way, which is up.
Well, guys, thank you for all of that insight. And I'm really looking forward to picking your brains on many different ESG topics in the series that we plan to do ahead. And with that, it's a wrap.
Thank you very much, Jordan.
Thank you, Jordan.
So those are the views from us, those are the trades from us, and that's the Fireside with Sook Leen and Jarek. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. If you're feeling generous, please do leave a review on your podcast store of choice, preferably a nice one, and please do log on to nomurakonnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.